However, it will still impact the closing total super balance. So again, just to be aware of that. Reserve allocations, transfers from foreign funds, compensation due to fraud or dishonesty. And then we've got some exclusions there as well, rollovers and lost super provisions. Right, so we've got the further definitions of what super earnings and taxable super earnings are. I'm going to flick over this because I've got a lot to cover, and I'm already running out of time. So a couple of exemptions here is the child recipient of a super income stream. That makes sense because in most situations, it would be very difficult for a child recipient to end up with $3 million, only because if their parent dies and a new pension is commenced for them, they can only commence a pension up to the transfer balance cap. And it's the transfer balance cap of the parent divided by the number of children that might receive a new pension. So it's highly unlikely, unless, of course, they had an asset in there that went gangbusters. Structured settlements, which is a good one, that's excluded, and that's not dissimilar to the transfer balance cap provisions there. Death if before the last day of the year. So what this tells us is just don't die on the 30th of June. And then because that's excluded, then we've got foreign super benefits. So if you've got clients that have a foreign scheme in the UK or somewhere in Europe, then that's excluded from any calculation here, which also makes sense because there's no way that those foreign schemes would report any of that information across to the tax office. Higher office amounts, so your judges, etc., and those in constitutionally protected funds. And then this other one that I really love is temporary residents who receive a departing Australia super payment, and have paid Division 296 tax at all. So this is a situation to be eligible for a departing Australia super payment. You've got to come into the country on a temporary visa and leave on that same visa. So if you've come into the country and been able to accumulate $3 million or more and then have paid this tax, I mean, you're doing a great job, I guess. And then when that DASP payment is made, because there's tax on that, then what will happen is any Div 296 tax that's paid across that will get refunded. Again, not expecting that to have wider application. And then you've got particular limited recourse borrowing arrangements that are included under the normal TSB provisions, but here they're actually excluded. So under the normal TSB provisions, if you've got an LRBA where the lender is an associate, so a related party loan, or the member has met a condition of release with a nil cashing restriction, then it's actually that the loan itself gets added back to the person's total super balance. In here, what they're looking at, it is going to be the net value of the asset that'll be included for total super balance purposes. Defined benefit interests will be able to run a debt account over the accumulation phase. When it gets to pension phase, they're going to have to for want of a better phrase, suck it up and pay the tax themselves, because it's highly unlikely that they're going to be able to go to their scheme and say, oh, look, scheme, can you pay this tax for me? Because that would then involve a substantially different calculation of what their ongoing pension is. Now, I've run the numbers on a couple of our senior politicians who are in receipt of defined benefit income streams, and the amounts are not too awful. And in fact, John Howard, he wouldn't be subject to this based on the formula that has been released. So it's this family law superannuation regulations. It's the formula that's in there. So that's just something worthwhile being aware of, is it's not too bad. It really depends, because of the way the formula works, it depends on your age at the time you start at the time. So if you're quite young, you might end up with a higher value from this perspective. But, with John Howard as an example, I think he's in his 80s. So his total super balance as far as the defined benefit scheme goes doesn't hit that. All right. And then a few other bits and pieces there. Right. I just want to show a worked example of how this all works, because, again, there's a lot of comments at the time about how awful it was, an extra 15%. But what this shows you is it's not an extra 15%, it's an incremental amount. So if we look at a smaller excess where we've got the closing total super balance is just over 6 million, then our incremental tax rate on the earnings, and we're using the same sort of 10% growth rate contributions, etc. It's about 7.36% with a medium excess. And I've just also noticed that my concessional contribution cap there is incorrect. That should be 30,000, but you'll see how it works here anyway. If it's a medium excess, it's nearly 12%. And then with a larger excess, obviously you're starting to ratchet up towards the 13, towards that 15%, but you'll never get to 15% from that perspective. So the latest, as I said, is that we're waiting on some debate and a bit of wrangling in Parliament at the moment. I know that the Self-Managed Super Fund Association has been lobbying very heavily with a lot of the politicians on the crossbench to talk to them about this. And because some of the biggest criticisms, but the main one is that unrealised gains rather, get captured in this calculation because we have to mark to market every year in a self-managed fund, and therefore, if you make a substantial paper gain, that could be subject to this tax. So we'll just have to wait and see what happens there. The other thing is that if you die, you lose your losses if you had that carry forward. The other thing is that I mentioned earlier, we've got the super fund bucket doing its thing, and then we've got the individuals bucket doing their thing. So along the way, the individual may have been paying tax on the increase in value on paper of an asset, and then they sell the asset in the fund. And of course, you can't offset that tax paid along the way against the tax that might be payable in the fund. So again, other criticisms there. The fact that it's not indexed is another big criticism. But the main one really is the unrealised gains. And if anyone is a nerd like me and likes, reading the Hansard that happens when these things get debated, there's some interesting comments there made by Allegra Spender and another chap who is a Nationals politician who has a lot of farming clients. So the big considerations there were it will stifle farming and people buying these assets in their farms, and it will cause some real cash flow issues because of farming values have gone through the roof, but the yields on them are not enormous. And the other one that Allegra Spender was talking about is that it would stifle innovation. So if you were to invest in an early stage investment company or something at the ground level, and then it does really, really well, then this is really going to stop people from perhaps making that call because they don't want to be hit with this tax. Anyway, we shall wait and see what that looks like. Okay, just a bit of an interaction with life events. And this is one of the so, as a general rule, I don't really like reversionary pensions. And mainly that's because, from a transfer balance cap perspective, they're a bit rubbish because there's extra work that needs to be done. And you can achieve the same outcome by having in place a good binding death benefit nomination or death benefit rule in your deed. Sorry, in your fund. So you don't need to have a reversionary pension. And in fact, a lot of reversionary pensions are put in place for the wrong reasons. And so it's just an area where I don't like them. Anyway, this is another reason not to like reversionary pensions. So we've got Homer and Marge. Homer's got 5.5 million sitting in his super. Marge has got just under 4. At 30 June 2025, Homer had $2 million in his pension and Marge had about 2.2. And her pension reverts to Homer. Now, she dies on the 1st of January 2026. And at the time that happens, her account is worth just under $2.3 million. Now, when she dies, that reversionary pension automatically becomes Homer's account. So it might not pop up in his transfer balance cap for 12 months from the date of death, but that's a transfer balance cap consideration. For total super balance purposes, as soon as Marge dies, that is Homer's account. So that means that his total super balance at 30 June 26 will include that reversionary pension. So just looking at this table here, we've gone from 5.5 to nearly $8 million. So that's a lot of an increase there. Now, there is a mechanism, obviously, for that net contribution to be reversed out. And you can see that there where this contribution gets taken out of the equation because we've got an increase in value of 2.5 million or thereabouts. Now, this withdrawal figure of the 211,000, That's both his minimum and her minimum. Because if he doesn't pay both minimum pensions before 30 June 26, then the pension exemption will not apply. So that's quite important from that perspective. So that will be added back. But the contribution, whoopsie, which wrong way, go there. So this contributions amount that will be removed from the equation. So we're looking at about $400,000 of earnings. Now, the consideration here is that even though that net contribution is reversed out of the formula, the reversionary pension still impacts the extent to which Homer is in excess of the $3 million threshold. So you can see there it's a 62% excess to the threshold. So 62.25% of nearly 400,000 gives us our nearly 250,000. And then the tax on that at 15% is about 37 odd thousand dollars. Now, in the next year, which is of equal importance, is to also have a look at how this works because, again, the reversionary pension isn't kind to us. So we start at 7.9, we finish at not that much difference. And the reason for that is we've got to take out nearly $450,000 worth of a withdrawal in this second year. Now, that's a function of Homer's own minimum pension, the minimum pension on Marge's account, plus if we have a look back, she had $2.2 million or 2.3 million in her account when she died, and his pension value was, say, about 2 million. So he can't keep all of her account in super because of the transfer balance cap. So what he has to do is then take that difference out as a lump sum payment. And then that, because it's come from his account, because it's his reversionary pension after that, that gets added back for this consideration here. So we've got, again, that's what that looks like. So just a couple of important things there. The extent to which we're in excess of the cap is impacted, plus the fact in this scenario that Homer has to take out an excess, an amount above the transfer balance cap from this reversionary pension. Otherwise, he would have an excess to his transfer balance cap. So what we're looking at there is about 80 odd thousand dollars worth of Division 296 tax over that 2-year period. From that perspective. Also included in that withdrawals total of the 450 or nearly 450 is the Division 296 tax from the prior year. Now, if it wasn't reversionary, this is what it looks like. So in that first year, if Homer isn't receiving a new or starting a new pension, then that doesn't impact his closing total super balance. It's just his own account that flows in from that perspective. So we've got his own withdrawals sitting there of 100. The extent to which he's over his Div 296 tax threshold is about 47%, as compared to here where it was about 62. And then his withdrawals total is only his own minimum pension. So we don't have to factor in Marge's at that point in time. So in that year, we've got $23,000 worth of Division 296 tax. Now, in the second year, when a new pension is started for Homer from Marge's balance, he would only start a new pension with the amount that he could up to his transfer balance cap. So in the previous example, there was an extra 300,000 that had to be taken out as a lump sum. In this situation, he would just start a new pension from Marge's account, say up to the $2 million, and that extra amount that needs to come out, he would just withdraw that from the fund and it comes off Marge's account. It doesn't come off his own. So that's then not an amount with that withdrawal that gets added back. So that's an important consideration there. So we still reverse out the new pension commencement that he has, which is just over 2 million, because that's his new pension. Now we are starting to get the extent to which we're over the cap being similar to the previous scenario, as you can see, and then the tax coming through. So what's the big difference here? So really it's just like a tax saving by not having a reversionary pension. Plus you don't have to do multiple interim financial statements to figure out what Homer's account was worth what Marge's account was worth on her date of death, as well as what Homer's account was worth a year after that, to make sure that you're undertaking the correct transfer balance cap provisions. So we're looking here, it's about a $20,000 tax difference. Now, in the scheme of it here, when we're talking about between the two of them, we've got about $9.5 million worth of assets. So they might not really give two hoots about a $20,000 tax difference, but sometimes the people that have $9.5 million in super have that for a reason, and it's because they want to save tax along the way. So just showing the impact here of reversionary versus not and how that interacts with a life event. The other consideration is in the situation where, say, one with the reversionary or not, where one member of the couple or both of them are under 3 million, and then it reverts all of a sudden, they fall within these provisions, which may not be ideal either. And then I've got a divorce scenario here. I'll just let you all, and I will send these slides through to Teddy so he can circulate them, so you can have a look at that in your own time. I'm just conscious of time already. Now, just quickly with the divorce considerations is that, and so I'll go back, is that my view is in a divorce, super should never be the adjusting figure or the balancing item as much as you can possibly avoid it, because it's a nightmare. And with respect to how Div 296 tax might overlay with divorce, is so back here I've got that Homer split 785. I'll get there. Whoops, one back. So they're doing Homer's splitting 785 of his account across to Marge. Marge is receiving 785,000. Now, Homer's that withdrawal will be added back, and Marge will get to remove that from the equation. So that's all about right, to be perfectly honest. But then how do we adjust for that difference? And again, most of you will probably agree with me that you've been involved in divorce matters where people will squabble over the last $5 just out of principle. And so it's worthwhile being aware that an adjustment on the super side might be a real challenge, because we're not going to know what the Div 296 liability will be, say, today when we're doing a property split, until obviously when it applies, until like the end of the financial year, to determine, okay, well, what was Gemma's total super balance? What is the proportion in excess of the cap, et cetera, et cetera. So it's worthwhile, if you're going to look at that, is that people just negotiate on what that figure looks like rather than waiting for a calculation to occur. All right. Now, back to this. Do we still make contributions? And the answer to that is yes, because usually those contributions are for a particular reason, like claiming a tax deduction personally. And at this level, we're talking the $30,000 cap. So we're not talking sheep stations. It has the benefit of reducing their own taxable income. And as you could hopefully see, the incremental increase is not awful. So it's still worthwhile from that perspective. Then the other one is, do I withdraw it all or some of it? Now, this is the biggest question I'm getting asked by clients. What should I do? Should I be pulling it all out, etc.? Sorry, my nose is dribbling. Too much information. Sorry about that. All right. So even with the overlay of this, super is still the best structure that is in the Australian tax realm. Now, what I am seeing is people say, right, well, I've got XYZ in super. I've done really well. How about I pull some money out, fall below, or just manage this position, and I'll give an early inheritance to my kids. And that is really where things are resonating with people, is that they're looking at, okay, I'd like to see my kids enjoy this. Let's give them, I don't know, a couple of $100,000 or something so they can pay off their mortgages or put their kids through private school or whatever that looks like. So it has prompted some of those discussions coming through sooner rather than later. Now, where I do think that what will occur on the basis that this comes through is people will start looking more at the the return profile of their investments. Because if you've got an asset that has got substantial unrealized gains and it's a long term investment, you probably don't really want to be paying tax on that along the way before you've realized the gain. So that is a consideration of maybe you don't have that asset in super, you put it in an alternative structure. Now, the consideration with that still remains is if it is in an alternative structure and you realise the gain, what's the tax position on that realised gain? So maybe the incremental tax you're paying along the way, it might even itself out, but we're crystal ball gazing there quite a bit about how will that asset perform. But it certainly is an education process with your clients to sort of say, right, Gemma, yes, you want to invest in that farming land. What's the succession intention with that, right? Well, let's not put it in super because also you're going to have to charge rent on it at a market rate. And if that goes up in value, you're going to be paying Division 296 along the way. So let's put it in a different structure where we can then manage the succession of it better and go on from there. So just to look out for that. Now, I've also run the numbers on the like almost a worst case scenario, which was looking at someone investing at the ground in their super fund. It was like $8 million, I think I started with, different rates of return along the way. And then looking at the impact of that, where the non-concessional contribution or the tax-free component in that particular account was only $330,000. And with various, and then looking at the Division 296 tax paid over time. And then if this person died, what would be the capital gain paid at the time on the realisation of the assets, as well as the death benefits tax payable if it went out and got paid to non-death dependents, and a regular portfolio turnover of stuff. So a few little bits of assumptions in there. Anyway, where the annual return was 20% ongoing, then the tax rate over time, so we're talking Div 296 tax, capital gains tax on the realisation of the assets at the end, plus a full whack of pretty much of death benefits tax was still only 32%. So that's with a 20% return year on year. So between, 10 and 20, it was under 30%. Now, you might be thinking, oh, well, a company, so that doesn't tell us anything, Gemma. But what that tells me is that, and at that time, that's everything out of the fund, all tax paid. And you've paid 30% tax on it. So there's no top up tax as if it was in a company. All CGT has been paid. So it's then fresh out of the fund in the beneficiary's hot little hands to then do what they need with it. And so even in that sort of scenario, it still wasn't horrendous. Now, no one likes paying taxes when they introduce these new ones. They're just, it's rubbish. And you'll remember when the transfer balance cap came in, that was an unmitigated disaster. So I suspect that, and that's why they're doing opening, total super balance, closing was quite clever because we already capture all of that information. But the side effect being it captures unrealised gains. Now, just quickly, the other tax rates, which everyone will be aware of. What I am getting more questions about also is investment bonds. So with an investment bond, it's tax-free after 10 years. And it's phased otherwise. Now, the downside of that is it's taxed along the way at the corporate rate. So you sort of are paying 30% tax at the corporate rate, but then there's no top-up tax when you pull the money out after the 10 years. There's no limit on how much you can put into an investment bond. But there's limits on, because it's an insurance product effectively. There's not that many. You can't just set your own up, basically. There's different products out there and you'd have to find a provider. So anyway, that is something that I'm getting more questions on. And in some situations, they are appropriate to have a look at. All right. So that's Div 296. A lot going on, a lot of watch this space. Hopefully, we see some common sense. But then that almost annoys me as well because we've spent so much time and anguish over a tax that they might then just throw onto the cutting room floor. So that's like just as annoying as if they change it. Anyway, if they change it, then we're back to the drawing board of figuring out how it's going to operate. Anyway, rant over for now. Hey, all right. So death benefits. Sorry, what we've learned. Now, there's a whole bunch of cases that you'll see in the slides that have come through and for a while, like over time. So the first one was Donovan and Donovan, and that spoke about the format of a binding death benefit nomination, um, and whether it was if the deed said one particular way for that nomination to be drafted and the legislation said something different, which one would take precedence. And then since then, we've had a whole bunch of other very interesting cases that have highlighted the importance of getting this sort of stuff right, because in an example of like Munro and Munro, basically none of the assets ended up going to the daughters. They all went to the spouse. And that is, it would appear, contrary to what the intentions were. Likewise, the Eopolo one, which is probably one of the first ones that came through and got a lot of press within the industry, was again about how the binding death benefit nomination, the legal personal representative stepping into the fund, is that a requirement, all of those sorts of things. Now, these are all in chronological order. So if you feel the need to read them, then if you're a nerd like me, you love all that sort of stuff. And then there has been a number in more recent times to have a look at. Now, in more recent times, the biggest one of note is Hill and Zuda. So in Hill and Zuda, the consideration was whether what the CIS Act says about there being a 3-year expiry date on a binding death benefit nomination, whether that applied to self-managed super funds or not. And there had been previous cases, and the tax office had their SMSF determination 2008-3, which basically said no, it clearly says in the legislation that doesn't apply to self-managed funds. But this was tested to the High Court. And the High Court, in quite a small judgment, basically said, no, it doesn't apply to self-managed funds. It's all about the drafting of the deed. So we go back to read the deed, read the deed, read the deed. That is the most important thing to have a look at. And so, again, if you've got clients that have deeds that are older than 2008, I would really look at them carefully. The other thing with that is making sure that even if they don't, is to check the chain of the deed updates, because I've encountered one recently and it had a principal employer in the original deed, and subsequent variations were not signed off by the principal employer. And so that means that they were invalid. You can't, the original deed says the principal employer like the amendment of a deed can only occur with the principal employer's consent. And so the subsequent ones weren't updated on that basis, and therefore they were invalid. And so it's really important to have a look at that. And if you read the Narriman case, which came in 2018, there was a whole bunch of different deeds and confirmations done, and a bit of what they were going to the court for was to confirm the situation, and what they wanted to achieve there, rather than it necessarily being a substantial dispute from that perspective. Right. So, like I said, what they've taught us is to read the deed, and all peripheral paperwork. And what I mean by that is we encounter, again, a lot of matters where uh, is it a reversionary pension or not? And the accounts might say reverts to Jemma, but have you actually confirmed that with the original pension documents? So reading those original documents. And then some deeds say that a binding death benefit nomination that conflicts with reversionary pension documents takes precedence. So people might be thinking, oh, I've got my reversionary pension, it's all good, that goes straight away to my spouse. And then they put in a death benefit nomination that would apply only if they survived their spouse, but it actually pays everything out to their kids. And it would take precedence over a reversionary pension if that was what the deed has as an order of priority. So we really need to look at that and double check that. One of my favourites, and it's a bit rough to say favourites, but because someone's died, is that this Corbasiri one, which went to the full federal court, and the outcome was that a text message does not break up a relationship. So I feel like it's got more of a consideration there from a pop culture sort of reference. Anyway, the things that keep us excited when we're reading cases. All right. So what we've learned is that we need to read the deed and all the other documents. It's really important not to have your blinkers on and just think, oh, I'll just deal with the super, because that can have then you miss stuff going on in the wider estate planning. So it might be, right, my super goes to son number one because son number two is getting a trust and son number three is getting another trust, let's just call it. Um, but in the end, that's actually not how it flows out. And a lot of the time, again, you can have a look and see through and say, oh, well, you've said that that trust is going to son number two. Actually, the way that it's drafted, the successor appointer is daughter number one. And so then she would actually have carriage of that asset, and there's no outstanding UPEs. It's all settled sum. So she's got full carriage of that particular structure, those sorts of things. So it's not a nice conversation to have with clients about what conflicts look like, and does everyone get on, and have you got any dodgy children or their spouses that you don't like, those sorts of things. But that is really where the conflict arises. And the last thing you want is that litigation, because that then just basically can completely wipe out a lot of the estate where someone contests it. Now, I'm in good old WA, and I'm pretty sure you guys are in New South Wales. Is that right, Teddy? Yep. So you've got the notional estate considerations over in New South Wales as well that you have to be mindful of. So estate planning at the moment, in the context of, well, just estate planning, but also super, is really, really important because there's so much money in super these days. We're going to see that massive transition of wealth from to the next generation, and it's really important that to avoid feeding the lawyers' coffers. Sorry if there's any lawyers on the call, and to make sure that people who are intended to benefit do benefit, and it's tax effectively structured with asset protection alongside that as well. All right. Now, the other thing to be aware of is with the transfer balance cap on death. And I mentioned earlier, I don't like reversionary pensions because of this. And the transfer balance cap, it's really important to make sure that you're aware of how this all interacts. It's the transfer balance cap of the survivor who might be receiving a benefit that is important. The cap of the deceased is completely irrelevant when you're getting to that planning. And then you've got to be careful of what your T-bar obligations are along the way, because now everyone's a quarterly reporter. And if it is reversionary, you have to, excuse me, you've got to report the value at the date of death within 28 days after the end of the quarter, not of when the transfer balance credit arises in the survivor's account, but within 28 days after the event, which is the death. So that's a bit rough, trying to say, oh, look, Homer, Marge has died, but can you send me all your documents for the super fund so I can do a realistic valuation of the fund as at Marge's date of death? Because we've got, 3 months to do it type thing. It's a bit rough. Now, at the moment, the tax office I'm yet to see a late lodgement penalty for T-bar, but I feel like it's easy pickings, to be honest. And I would expect that to come through sooner rather than, well, at some point in the not too distant future. So just to watch out for what those obligations are. All right. And again, I've got some scenarios here, but I just wanted to cover off on a couple of other things. And actually, with my Homer and Marge scenario here, what's particularly of relevance is this death benefits tax. So this is the figure here, nearly $650,000. So in these scenarios, that's also a consideration, and I have ongoing discussions with clients about this as well, which is do they, and particularly they're getting older, they're in their 80s. They probably don't necessarily want to run a self-managed fund anymore. And they're looking at, again, what are the tax and succession implications. So they're looking at, if I move my money out of super, then I'm going to lose these tax concessions, but then I'm going to save my family 650 grand. And so, how many years worth of tax concessions lost um, until I'm sort of squids? So some of them are looking at this consideration and saying, look, if I survive for 5 years and if I've pulled this out and I invest it outside super, if I survive for more than 5 years, then I should have kept it in there. Because of the tax concessions. But and particularly if I'm hit with Div 296 tax. But if I rip it all out, maybe give some of the money to the kids now, I can easily live on this level of funds, put it in a discretionary trust. I can then set up the succession of that to how I want. And then I'm saving the family 650 grand in tax. So again, these discussions are becoming more and more prevalent, I'm finding. And people are, their own mortality is not a nice thing to bring up, but they're very pragmatic about it. And they're having the discussions with their children as well. So, particularly if there's the survivor of a couple, what does that all look like, etc. Um, so knowing when you're going to die is the ultimate here, but I know that's a very flippant comment to make because that is quite a challenge. But then if the family is aware and you've got the right powers of attorney in place, then you can actually initiate, as long as the person doesn't get hit by a truck and die instantly, then there is the opportunity to initiate the payments out of benefits if someone is sort of on their last legs, which I know is less than delightful to bring up, but it is reality from that perspective. Now, I've noticed that I've hit the 6:30 mark, but I'm going to keep going because Teddy tells me I've got till 6:45. And I just wanted to cover off a little bit on non-arm's length income and non-arm's length expenses. Now, this is an area where we've pretty much gone full circle to the point where, like, who cares on general expenses? So initially, we were looking at general expenses that weren't arm's length could taint the whole income of the fund. Then there was, because that was the tax officer's view, then there was the law companion ruling that came out and went through all of that, the practical compliance guidelines that went through that, but really kicked the can down the road for a few years because it didn't just impact self-managed funds, it impacted all the big guys as well. And I think because it impacted super more widely, that's why it got quite a lot of airtime. So after all of that, then the consideration was to change the factor and say, right, if you've got non-arm's length general expenses, if you need to, if 5 times what the non-arm's length amount is, that is taxed at 40 at the highest marginal rate at 45%. And then the final draft legislation that came through was 2 times. And so I'm just sitting there going, my goodness, is that even remotely material now? Who cares? Because of more concern for me in these sorts of from a non-arm's length income perspective is asset specific expenses because the can got kicked down the road for general expenses of a fund but not asset specific. So if you've got clients where they did a transfer of I don't know, Westpac shares $100,000 worth into their fund. And the fund paid $50,000 in cash across, and the balance was going to be a contribution. Now, the tax office's ruling TR 2010-1 said that if you don't pay full consideration, then the balance is a contribution. And everyone just happily went along like that, right? But with these provisions, what happens then is if the off-market transfer form only has a value in it at 50,000, even though they're worth 100, then that will be gnarly for those shares or a non-arm's length expense because the fund didn't pay full consideration because the paperwork doesn't represent that. And that then means that all dividends on those Westpac shares and any realised capital gain in the future will be subject to non-arm's length income. and yuck, right? So we're certainly seeing this a fair bit when people have got related unit trusts or unrelated unit trusts but closely held, and they're reinvesting everything at a dollar because things aren't being acquired at market value. So there's some real concerns from that perspective. So just to be aware of how that all flows through from that perspective there. So the general expenses, I've been flippant and said, who cares? Obviously, it's still relevant. It's quite immaterial, I would expect, in most situations, because here doesn't apply to the big funds. Here we're looking at accounting fees that weren't market, investment management fees that weren't market, and perhaps property consultation fees that weren't market. The other thing that might taint an asset for good is if any capital works are done to a property by someone who is a qualified builder and they don't charge an appropriate arm's length fee for that. So again, everything really just needs to be commercial, at market, etc., to make sure that there's no issues. I call it the Goldilocks approach. So you can't have too much income generated in the fund, but you can't have too little because then Section 109 of the SIS Act kicks in. So we need to be just right in the middle, that Goldilocks approach. Now, there is this tax determination that was finalised in July, and I refer to it back here as it being in draft. So I will update that before it comes through. So that was finalised in July, and it spoke about the non-arm's length income provisions interacting with CGT. And where there is a non-arm's length income gain, then that can almost taint the gains for the rest of the fund. If there's a non-arm's length income gain, but a capital loss, so we're talking capital gains here, but a capital loss on other assets, that can actually be of assistance. Now, I've read this determination a number of times and it confuses the life out of me. So just again to watch out for what that looks like. Now, Jenny has a question. Do you want to, I don't know if you need to type that or if you can show your face or talk.
You can unmute yourself, Jenny, if you want to ask the question directly.
Otherwise, type it in the chat and I'll keep going. Now, there also was a non-arm's length income case that came through, which basically the commissioner was looking to say, look, because you were related, you weren't dealing with each other on an arm's length basis, but the the tribunal came back and said, even though they weren't arm's length parties, they were dealing with each other on an arm's length basis. Now, if you read through that case, there was a lot of in-house asset issues as well. But anyway, it's interesting that we got a good outcome for the taxpayer through that mechanism there. All right, a couple of other bits and pieces to have a look at. So the indexation impact. So in the current year, we do have the situation that the total super balance threshold for non-concessional contributions has actually gone down from the prior year, and that's because the contributions, the concessional cap was indexed, but the transfer balance cap was not. And so just for this year, just to be mindful of that. So you've got to have less than 1.66 million in total super at 30 June 2024 in order to make a $360,000 contribution, whereas last year it was 1.68. So that's just the function of how the formula works, because the way the threshold, so it's 1.9, or the transfer balance cap upper threshold, the standard is our starting point. That's the upper total super balance threshold. And then the next threshold down for non-concessional contributions is the general transfer balance cap less the single year non-concessional cap. So that's why 1.9 less 120,000 gets us to 1.78 million. And then the next one down is minus 2 times the non-concessional cap to the 1.66. So just to watch out for that with clients looking to make those sorts of contributions this year. Like I mentioned earlier, the expectation is that the transfer balance cap will be indexed to $2 million for 1 July 2025, but also that seems like an eternity away. Although in saying that, we're basically in September, so where did all that time go? All right, a couple of other things to be mindful of from an ATO perspective, from a compliance perspective. So the first thing is that if you've identified a breach and you reach out to them to try and rectify it, the first thing that they will say to you is get your funds compliance up to date before we'll even look at it. So that's the first thing. That can become a challenge if you need their guidance on a particular matter. And they do have a voluntary disclosure service available, which I'm not a massive fan of using, I've got to say, because usually that triggers an audit. And sometimes you go down the voluntary disclosure path because you're trying to remedy an issue, and then you haven't quite remedied it because you're putting a plan to the tax office to say this is how we want to do it, and then they launch an audit and you haven't got everything up to date yet. So my preference is always to just determine the best way to deal with it, get everything up to date, and then fix it. And then the auditor will lodge their ACR. That'll go to the tax office. And my experience to date is that that generally doesn't give rise to any substantial issues on the way back. But just to be aware of what that looks like. So they really hate it when people are out of date. So just to watch out for that. And that statistic from November 23 was that 90,000 SMSFs were still unlodged for the 21-22 year in November 23. Now, I don't know what that stat looks like now, what that looks like for the 2023 year, but that's a bit frightening when you consider there's 650,000 SMSFs in the country and 90,000 of them, so say 15% of them, were unlodged in November 23 for the 21-22 year. Now, I'm sure everyone will agree with this. Resourcing has been a challenge. Staffing, all the extra work that needs to go in. So I don't think anyone is throwing stones or anything like that. But it was an interesting statistic just to have a look like that at that. And the other thing why the tax office doesn't like non-lodgement is that they think automatically that you're doing something wrong and you've got your head in the sand. So just to watch out for that. So my advice, if in these sorts of scenarios, is early engagement with the tax office, where so we encounter where people have been scammed. They've got no money left in their super. How do you deal with it? So usually the tax office is pretty pragmatic about that if you engage with them early. Likewise in divorce, because people don't want to sign anything. So stuff can sit there unlodged for years because people don't want to sign it. Again, that early engagement, letting them know, putting it on the file for the fund with the tax office does help a lot from that perspective. And I already mentioned the voluntary disclosure. With death benefit payments, I mentioned earlier, if you know when you're going to die to try and pay out your money, there's been a few PBRs, private binding rulings on that, that looks at the timing of all of those things. So worth a look if you've got some clients where they might be contemplating that. But again, it's really a small element of a wider estate planning consideration and conversation to be had with the clients. All right. So anything else? Well, I'm just going to go straight to my last slide here, which is that with Div 296 tax, really, it's awareness that is key. Having those conversations with clients, I'd be really resistant to any big changes at the moment to people's funds, unless they were buying an asset that where, now, and they needed to understand what the implications were. So it really is that investment decision and matching the return profile of the asset to the tax profile and succession profile of the structure, really is ultimately where that lands. It's worth a review of any binding death benefit nominations and trust deeds and estate planning arrangements, because there's been quite a lot going on there. Pension payments, we're still in full percentage mode. We've already picked up a few in 23, 24 where they haven't met their minimums, which is a bit of a shame. And then the other one that I love, which is this increase of the non-concessional cap available to those up to 75 without needing to meet a work test. Plus, it's the 3-year. So that gives rise to quite a few withdrawal and recontribution opportunities for clients, and that can help with them managing that death benefits tax. Now, on that note, I am going to hand back to Teddy and blow my nose. Delightful. Sorry.
Okay. Anyone have any question? You can raise them in the chat box, or you can raise your hand and unmute yourself. You can ask directly. Um, and we've got a couple of minutes before we close off the meeting. Um, if there's no question, I've got one question for you, Gemma. With the the gnarly and gnarly, I know it can be a whole topic of its own, but yeah,
Yes.
when you say general expenses like accounting the fee, when we charge our own fund,
Yes.
how do you determine the market value?
So that's a very good question. And because some people would say, well, you can go out there and get a fund done for 800 bucks, which includes audit. So can I benchmark to that? The outcome of that is you need to benchmark to what your firm would charge for a similar fund. So if your firm wouldn't charge 800 bucks, they would charge $4,000, then that is what you're benchmarking to.
Hmm, okay.
So
What
yeah,
about the
that's a
income?
consideration.
What about the income? Say if we got our own premises and we lease out to our own our business,
Hmm.
and how do we determine the rental income, the
So that's
market
where you
value?
get a market valuation done. So
Ah,
you get your market value for capital purposes for the market for but to represent in the balance sheet for the fund at year end, and then I would get your valuer to also do an income um, a market valuation of the annual income as well, so you can see how that
hmm.
flows through. And
Is
then
that a
your gold,
problem?
and then you've got your Goldilocks. You know, you're covering off on that.
Is that a problem if we undercharge?
So if the fund undercharges, then the issue you've got with that is that's where the Section 109 kicks in, because Section 109 says that the fund has to deal with all parties on an arm's
Mm,
length basis. And if they're not dealing on an arm's length basis, for example, with a related party, then as long as the fund is not detrimented to the benefit of the related party. So if you're not charging sufficiently, then that's a 109 consideration.
mm.
So that's why, like I said, that Goldilocks in the middle. So a market valuation that covers off on the value of the property, but then what that market rent looks like.
Okay. All right. Looks like there's no other question. Graham, if you have any question, just unmute yourself.
Maybe you can't.
Mm, no. Okay. So there's no other question. So on behalf of CP Australia City Taxation Discussion Group, Henry, I would like to thank you, Gemma, for your time, effort, and contribution to our group, despite not feeling well tonight. We know that super can be very complex and complicated. So if it's always good to get an expert assistant. So if you have any further question, please, you can contact Gemma directly, and I'm sure she'll be able to help you and your client further. So
And
thank
I'll
you.
sorry to interrupt, Teddy. I will send you the slides so you
You're
can circulate them to everybody.
okay. No worries. So thank you all once again for attending tonight's session. Thank you to over 100 people that attend tonight's session. Appreciate your time as well. We hope to see you all back again in 2 weeks' time at CPR office. So until then, stay connected and stay healthy.